Hi folks, Mike Larson here with an important update on what's going on in the markets. As we sit here and we watch the euro currency disintegrate, the junk bond and the high yield and corporate and municipal bond markets get hammered hard and stocks fall through key levels, I can't help but stop and think that this was all foreseeable in some way. What we said a long time ago, both Martin and I, is that when faced with the private debt market collapse, a Wall Street collapse, Washington had two choices. Let it play out, get the rot out of the system, crush those debts, and set the stage for a healthy recovery, or take all the garbage that was on the private balance sheets and move it over here to the public balance sheets, and therefore transform a Wall Street debt crisis into a Washington debt crisis. Now we're seeing the results of that policy choice that they made explode onto our screens every day. We're seeing the euro tank, and we're seeing bond yields in some of these countries, these peripheral countries in Europe, soar as investors realize these debts and deficits that have been piled up are unsustainable. Next up, I believe we're going to see something similar happen in the UK, and then eventually here in the United States. Because again, there's a very simple message. You can either take your medicine, suffer the short-term consequences, and ultimately set the stage for a healthier long-term recovery, or you can try and paper over the mess, print money, borrow your way out of the problem, and then try and put off the day of reckoning. That worked for a while. That's why we had the rally off the early 2009 lows. But as we told many of our subscribers recently, we now appear to be breaching that uptrend. And I think now we're heading back to a resumption of the bear market. And that requires important steps for you to take in your fixed income and in your stock portfolios. Namely, cut back on risk in stocks. And also, especially if you've been participating in the rally we've had in junk bonds or corporate bonds, get out of that stuff, because that's going to get hit hard as the economy slows and as this crisis unfolds, again, in currency and debt markets. Thank you.